Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. Great to be with you.
And we also have with us Alex Stanley, the managing director of Physical Gold Fund. Hello, Alex.
Hi, John. Great to be here. We have some very exciting topics to discuss today, so looking forward to getting into it.
We certainly do. Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question, and as time allows, we'll do our best to respond to you. Now, just a word about Q&A, because we want to emphasize today that we really value the questions that you send us, and we decided to increase the portion of time each month to your questions. But today we will begin with an interview covering some very significant market developments that we've been seeing since our last webinar. So, talking of which, Jim, it seems like the West is finally waking up to gold. Let me quickly list off just some of the factors. We've seen a roughly 20% rise in the dollar price of gold since the beginning of the year. We've seen a dramatic, less reported, but a dramatic increase in gold buying by institutional investors. By reports I've seen, over 13 billion in net inflows this year compared with 2.5 billion net outflows in the last quarter of 2015. But not only that, there's a change in the conversation. We're seeing big names in the financial world coming out with positive statements about gold. People like former IMF chief economist Kenneth Rogoff and billionaire fund managers like Paul Singer, Stanley Druckenmiller, Jeffrey Gundlach, and institutions like JP Morgan's private bank and the massive investment firm PIMCO. And we'll talk about some of their particular pronouncements later in this interview, but just to begin with, Jim, stepping back to look at the big picture, what's driving this turn in the market? I wondered, has everyone started reading your latest book, The New Case for Gold?
Well, John, thank you for the kind words about the book. I think, as you know, as we've discussed, books don't come out of thin air. Unlike money, money does come out of thin air, at least central bank money does. But books don't. They have a very long lead time. So we've all been working on this book for over a year. There was no way to know a year ago that we would have a publication date in the strongest performing quarter for gold in over 20 years. So that was, cannot take credit for that. It was fortuitous or serendipitous, but certainly the timing's been good, and the book has received a very good reception. But you're right, there's definitely a change in the conversation, a change in the environment, and it's not just the price. Yeah, the price action has been good. Gold's up over 20% so far this year. Best performing asset class. If you look across stocks, bonds, other commodities, various currencies, etc., gold beats them all this year. That's, by the way, not only true this year, it's true for this millennium, or this century, if you will. If you go back to January 1st, 2000, gold has outperformed all the other asset categories I mentioned. Investors are only too aware of the gold drawdown from August 2011 to November 2015. Not a lot of fun, but if you take recent action or longer horizon action, gold has done what it always does, which is it preserves wealth and holds it very well compared to other asset classes. But that it's not just the price. There's definitely a change in, I think you put it, the conversation. And this goes back to something I wrote a little while ago. I said gold is a chameleon. And what I meant by that, of course, I think of gold as money. But I said, you know, there are times when gold trades like a commodity. It's in the commodity indices. It's part of the commodity complex. It looks like a commodity because you dig it up out of the ground the same way you do with copper or iron ore, etc. I don't really think of gold as a commodity, but there's certainly times when it trades that way. Gold is also sometimes considered an investment. It competes in institutional portfolios for an allocation side by side with stocks and bonds and some of the asset categories we mentioned. But sometimes gold is money. And I think what happened, I trace this really to late 2014, but it really gathered steam recently, is that investors in general are losing confidence in central bank money. If you think of it as a competition, there are a lot of forms of money. I would say the dollar is money, the euro is money, Bitcoin is money, gold is certainly money, silver can be money at times in the past, feathers and clamshells have been money. So money can take many different forms based on shared values and confidence that other people will take it as a unit of exchange. And right now what's happening is that investors are looking at central banks. They're saying, 7 years on, almost 8 years from the financial collapse, growth is still well below potential. Debt is still rising faster than growth. Debt to GDP ratios are increasing. True, we have not seen that sort of spectacular collapse in the international monetary system, which I do expect. I'm certainly not taking that off the table. I've been writing about it and thinking about it for a long time. It hasn't happened yet, but the signs are that the system is under more and more stress. And the central bank policies are not only failing to get economies back to trend growth, but they're increasingly seen as futile. In other words, if you just do more, it's like the old joke about, more cowbell from that old Saturday Night Live skit. Doing more isn't working. And so if you're an investor and you say, well, we don't have much confidence in the Fed and their dollars, or the European Central Bank and their euros, or the Bank of Japan and their yen, is there another form of money out there? And the answer, of course, is gold. So I just think that gold is winning the horse race, if you will, among various competing forms of money. And that's getting some attention and getting some commentary. Now, we'll spend a little more time in the interview on some of the specifics of some of the names you mentioned. By the way, John, it was a pretty good list. You had Stan Druckenmiller, one of the most successful long-term investors of all time, one of the great hedge fund managers, protege of George Soros, went out on his own. Luther King Capital Management now runs it as a family office, but one of the best long-term track records out there. Same thing with Paul Singer, runs Elliott Capital Management, and a few other names you mentioned, but you left out the biggest one of all, which is understandable because it's only in the last 24 hours, but George Soros, came out the other day, and he didn't actually make a public statement, but what happens for large institutions, they have to file a form called a 13F. That's one of these SEC forms. They come out quarterly, a certain number of days after the end of the calendar quarter. And depending on your size, if you're above a certain size, you have to actually disclose what you're holding. So the Soros 13F came out, and analysts had a look, and what they saw was that he had decreased his stock market bets 37% and increased his gold bets very significantly. In particular, bought a very large stake in Barrick Gold, which is either the first or second largest, I think it might be the first largest gold mining operation in the world, Canadian company. Interestingly, the chairman of Barrick Gold is John Thornton, former co-CEO of Goldman Sachs, and very well connected in China, very close to the Chinese. Actually has spent a lot of time in Beijing, has an there. So Thornton's an interesting figure. Again, top guy at Goldman Sachs, one of the most connected Westerners in China, and the chairman of Barrick Gold, and that's the company that George Soros is buying into. So these guys are, when you talk about Druckenmiller, Singer, and Soros, you're talking about the best. They're not flash-in-the-pan guys. They've been doing this for 20, 30 years. In Soros' case, more like 40 years. So I do think it's a very, very significant development and a change in sentiment. We're also seeing it in gold mining stocks. I'm not a stock picker, but there are fabulous opportunities there, and for those who do the analysis and can find the right companies. So yeah, I think sentiment's changed, fundamentals have changed. We've said on this podcast, going back over a year, we said the technical setup was there. We were seeing physical shortages based on our conversations with people on the physical side of the business. By physical, I mean refiners, vault operators, secure logistics operators, dealers, entities like the Physical Gold Fund, where they handle the real stuff. When you deal with Physical Gold Fund, you're talking about physical gold kept in a vault. This is not paper gold. So from that end of the business, we've seen the tightness in supply for a long time. We've also seen the voracious demand coming from China and Russia notably, but also Iran, Kazakhstan, Mexico. There are a lot of countries around the world who are acquiring gold. There are no central banks that are selling any significant amount of gold. People made a big to-do about the Canadians dumping their gold, which is too bad for Canada, but they only had 3 tons. It wasn't as if they were dumping 30 tons or 300 tons. They only had about 3 tons left, and they did dump it. So no significant selling, a lot of significant buying, physical shortages cropping up, the paper gold to physical gold ratio near all-time highs, COMEX warehouse being stripped practically bare, open interest relative to physical gold close to all-time highs. So the setup was there for a big price increase, so that's not surprising. But combine that, let's call it the technical setup, with the fundamental setup, which is lost confidence in central bank money, and then smart people coming out with a kind word to say about gold. It's been a good run, but this is just beginning. Gold could go up or down on any given day. It's down a couple bucks today, but I'm not a day trader. That's not how I think about it. I think about it as a store of wealth, as a way to protect yourself against the storm and coming collapse in confidence in central bank money. So, but it's not too late to get in. This thing has a very long way to run.
Well, thanks, Jim. That is an extraordinary combination. And now drilling down a little bit into what's being said by some of these smart minds. I mentioned PIMCO in that last question. This is something you've written about recently. Let's take a look briefly at an article they just published. Article's a bit coy in tone to my mind, but it floats an idea for fighting deflation, or if you like, encouraging inflation, which of course we know the central banks want, the Fed wants anyway, that you've mentioned several times in our conversations. And here's the idea, very simply, the Fed could jack up the price of gold, which would have an immediate inflationary impact without the downsides of the familiar gambits like quantitative easing and negative interest rates. Of course, to do this, the Fed would be treating gold as money. So I guess they'd have to eat a rather large helping of humble pie. Is this move even remotely likely?
Well, not only, I think it is likely, John, but not only is it likely, it has happened before, and now it's getting a kind of a second life, at least in terms of public commentary on this. The specific article you're referring to, I think the title had to do with Rumpelstiltskin, the old nursery tale or fable, Rapunzel, Rapunzel, let down your hair that I may climb the golden stair. So you're right, the author was a little bit coy, but he had good reason to be coy. The author was Harley Bassman, one of the top economists at PIMCO, but he had reason to be coy because think about what PIMCO is. PIMCO is the largest, most sophisticated bond investment fund in the world. It's owned by a company called Allianz, which is one of the largest insurance companies in the world. You can't get much more institutional than PIMCO and Allianz. So it's one thing for an author, an analyst, someone like myself to say these things, and I have said them many times, but when PIMCO comes out and puts their name on it, I consider that a very big deal because, as you know, anyone with a kind of a kind word to say about gold is inviting ridicule, but here's an establishment figure saying the same thing. Now, what Bassman said specifically, he was addressing the issue of deflation, which you mentioned. Deflation is the central bank's worst nightmare. It's the thing they fear the most. They actually don't fear inflation. They want a little bit of inflation. They're not getting what they want. I call this Jaggernomics in honor of Mick Jagger because the Rolling Stones had the song, "You Can't Always Get What You Want," and the Fed wants inflation and they can't get it. They've been trying for 8 years. They've tried everything under the sun, QE1, QE2, QE3, forward guidance, currency wars, Operation Twist, zero interest rates, in Europe, case of Europe, negative interest rates. They've tried everything and it hasn't worked. And deflation is their worst nightmare because it increases the real value of the debt. The U.S. debt burden is already non-sustainable. That's beginning to sink in. We haven't seen a debt panic yet, but the elements of non-sustainability, namely that your debt is growing faster than your economy. See, debt is manageable. If your economy is growing faster than your debt burden, the debt is manageable. People just kind of shrug and say, well, yeah, the debt's going up, but the economy's going up more, and so they can afford to pay it, and that's satisfactory. But we have the opposite situation, that the debt burden is going up faster than the economy. The debt to GDP ratio is growing. We're on the path of Greece. Maybe we're walking that path a little more slowly than Greece, but we're heading in the same direction. And so one way to solve that problem It'd be nice if you could grow your way out of it, but the structural setup for growth is not there. But you can inflate your way out of it. That's sort of the American way. And that's the real reason the central banks want inflation and want to avoid deflation, because deflation actually increases the real value of the debt. It makes everything I just said even worse, and if we're already non-sustainable, then deflation would make it even more non-sustainable and hasten the day of collapse of some kind or another. So the central banks have to get inflation, but they haven't been able to get it. So I've said on this podcast, and I've written in the past, that you can have inflation in 15 minutes. All you have to do is for the Federal Reserve to go into the boardroom down on Constitution Avenue, close the door, take a vote, walk out 15 minutes later, and announce, Janet Yellen in front of the microphone, ladies and gentlemen, as of this minute, the price of gold is $5,000 an ounce. If you think that's cheap, come and get it. You can buy all the gold. The doors of Fort Knox are open. And if you think that's expensive, sell it to us. We'll take it off your hands. Well, if you have enough gold, which they do, they have 8,000 tons, and if you have a printing press, and you make a two-way market, you say, our target price is $5,000 an ounce. We're buyers at $49.95. We're sellers at $50.50. If you think it's cheap, come and get it. If you think it's dear, we'll buy it from you. If you do that, which they're capable of doing, then the price is $5,000. You just make the price $5,000 by diktat, if you will, and you conduct open market operations and make a two-way market to make it stick. Well, the point of that, the purpose of that, would not be to enrich holders of gold. I think a lot of listeners on the call and the clients of fund, and some of us personally, would do fine in terms of the price of gold going up, but that, of course, is not the reason to do it. Nothing happens in a vacuum. If you take the price of gold to $5,000 an ounce, you're going to take the price of gasoline to $10 a gallon at the pump. Silver would be $100 an ounce. Groceries will go up. Coal, wheat, corn, steel, every commodity of would go up along with gold. It wouldn't really be, taking gold from, let's say, round numbers, $1,000 an ounce to $5,000 an ounce, don't think of it as a 400% increase in the price of gold. Think of it as an 80% decline in the value of the dollar. If you hold an ounce of gold constant as a unit of weight, and increase the dollar price 400%, you haven't changed the value of gold. What you've done is you've destroyed the value of the dollar. That's what inflation is. That's almost the textbook definition of inflation. So that's the way for the Fed to get inflation. As I say, in 15 minutes. They don't have to wait 7 years of all these crazy policies. That they could do it by order. And by the way, that's happened before. For those who think that's highly improbable, it's exactly what happened in 1933. Between 1929 and 1933 was the longest period of sustained deflation in U.S. history. The government was desperate to break out of deflation, and they did it by increasing the price of gold 75%, from $20 an ounce to $35 an ounce. Well, why does the price of gold go up 75% in a deflationary environment? Well, the answer is that the government wanted to cause inflation, and the easiest way to do that is to devalue the dollar, and the easiest way to do that is to raise the dollar price of gold. So that's the analysis. What struck me about Bassman's article, two things. When I read it, I thought to myself, gee, that sounds familiar, and I opened to page 244 of my book Currency Wars, which came out in 2011, and I had laid out exactly the same scenario, slightly different numbers, but the book's 5 years old. Of course, I've written about that and spoken about that many times, but so I don't know whether Harley is going to send me a royalty check, but I just say welcome to the conversation. When I see ideas like that being copied almost verbatim, I don't get upset. I think actually secretly that's good. We've added one more voice, an important voice, to a very important conversation. Be that as it may, many people could come up with the same idea on their own. What struck me was not the idea, which I had written about before, but the voice that was coming from PIMCO. This was the establishment. This wasn't Zero Hedge. This wasn't some fringe player. This was PIMCO talking. Now, the other article you mentioned, I'll just spend a few minutes on this, was Ken Rogoff. Now, just to situate that, Ken Rogoff, as you mentioned, was the former chief economist of the IMF, International Monetary Fund. He's a full professor at Harvard University. He's the author of one of the best-selling economics books of the last 10 years with his co-author Carmen Reinhart. This time it's different. Ken also happens to be a chess grandmaster. He seriously considered a career as a professional chess player before he went into economics. So needless to say, he's a big brain, very nice guy, but the point is, the reason I'm reciting his resume is to make the point that you can't get any more establishment than Ken Rogoff. By the way, word is that he's on the short list to fill one of the vacancies on the Board of Governors of the Federal Reserve. There are 7 seats on the Board of Governors, but right now 2 of them are vacant. They've been vacant for a long time. The White House has been very slow to fill those seats, to make those appointments, but there's some talk that Ken Rogoff might be on the short list to fill one of those seats. So the point being, you can't get more establishment, more mainstream than Ken Rogoff. He wrote an article about a week ago and recommended that emerging market central banks allocate 10% of their assets to gold. And I almost fell off my chair. I said, wait a second, Harvard, IMF, this guy's saying go out and buy gold, and that's exactly what he was saying. Of course, the 10% number resonated with me because I've said all along many times on this podcast that 10% is my recommended allocation. Again, I'm sure Ken thought of that on his own, but it's interesting how there's some convergence of ideas here. But the article is even more interesting than that because he gave some reasons. He said, well, you've got too many dollars. You need to diversify away from dollars. And he was thinking about gold as money. He wasn't saying, oh, go buy euros, go buy Japanese yen, go buy Swiss francs, and you can buy all those currencies or invest in securities in those currencies. He was saying go buy gold for 10% as a diversification of your reserves because emerging markets have too many dollars. And he was referring specifically to this whole very dangerous risk on, risk off, hot money dynamic where the Fed, and this happened this afternoon, as a matter of fact, the Fed talks about, well, maybe we're more likely to raise rates, and all of a sudden, everyone sells emerging markets, sells Malaysia, Indonesia, Turkey, South Africa, dumps all those stocks, dumps those currencies, buys dollars, gets back into U.S. money markets because they think the rate's going to go up, and then the Fed decides, just kidding, we're not going to raise rates after all, and everybody shorts dollars, borrows dollars, goes back into emerging markets. Anyway, you get these huge swings, and I travel around the world a lot. I mean, I go to Malaysia and South Africa and Turkey. I've been to all these countries recently, and this is all they talk about. Their markets skyrocket when it's risk on, and they crash when it's risk off, and their currencies likewise, and they sit there and say, wait a second, we're not doing anything. We didn't change policy. We didn't change our tax rate or central bank policy. It's the Fed that's raising or lowering expectations about rate hikes is causing all these crazy hot money inflows and outflows. So Rogoff's saying, well, if you had gold, you wouldn't have to worry about that. People wouldn't be dumping gold just because the Fed was going to do one thing or the other, and it's a way to diversify your reserves, insulate yourself to some extent from this risk on, risk off dynamic, which is very dangerous. All of which I agree with. I agree 100%. I was just shocked to see a Harvard professor sort of coming over to our side of the debate. He said something else that was even more fascinating. He said, this is his advice to emerging markets. He said, don't worry too much if there's scarcity of supply because the price will go up. Well, of course, that's exactly what you should expect. If there's a certain if you have increasing demand because emerging markets want to have more gold and you have tight supply conditions, which we've already talked about, the classic market solution to that is for the price to go up. And what Rogoff was saying is you're going to start out with a target, right? Let's just say you have I'll use a round number, $1 billion of reserves, and you have to get you want 100 million in gold. Well, you'll start to go out and buy the gold, trying to get at a certain price, trying to get to that target. You might find that you can't get any gold. And Rogoff said, don't worry because the price will go up. In other words, the way you get to 100 million, there are 2 ways. One is to buy larger quantities at a fixed price. The other one is to not be able to buy it at all, but watch the price go up because of tightness in supply and demand. So, which is also exactly right. And I said that in my book, The New Case for Gold. I said, you never have to worry about running out of gold because the price will go up. You can support any amount of asset allocation or any amount of money supply, any amount of traded finance with a fixed quantity of gold just by increasing the price. So here's the recommendation for emerging markets to buy gold. Do so because the dollar is dangerous, and don't worry about scarcity of supply because the price will go up. That's the trifecta for gold investors. It's exactly what we've been talking about for a couple of years on this podcast. But again, not to belabor the point, John, but these are familiar arguments to our listeners and our audience. Familiar is when Druckenmiller, Soros, Singer, Rogoff, Pimco, all these names come out and say the same thing. Then you know something's going on.
Well, there's one other voice, but this one's really coy, and I don't know how to interpret it, but Alex pointed this out from a speech just published by the chief economist of the Bank for International Settlements. And he's addressing this issue of diversification away from the dollar and says, just diversifying currencies doesn't work, basically. And then he goes into analysis of the sort of structural problems in the world's monetary and financial system. And he says that what it lacks is what he calls an effective anchor. It doesn't describe what that anchor might be, but is that speech even possibly clearing the way for introducing gold as a more central and overt player in the organization of the international monetary system?
There's no doubt about it, and you're referring to Claudio Barrio, who's the head of monetary economic research at the Bank for International Settlements, so-called BIS. For listeners who may not know, the BIS is the central banker's central bank. Now, I've often referred to the IMF, the International Monetary Fund, as the central bank of the world because they have this money printing function, which they do, but the BIS is even older than the IMF. It's based in Basel, Switzerland. It was created in 1930. I call it a treehouse for central bankers. Like when you're little kids, you want a treehouse to get away from your parents or get away from scrutiny. So this is where the central bankers go once a month, and the top ones, the sort of G10 economies, have a nice lunch overlooking the river there in Switzerland. They close the doors. There are no minutes, no records, no statements, no press conferences, no accountability. Nobody knows what goes on inside that room unless you're in the room or speak to someone who does. Interestingly, one of my former partners, David Mullins Jr., was the vice chairman of the Federal Reserve. He said, Greenspan didn't like to travel that much, and often David was the one who had to go to Switzerland and sit in on these meetings as a representative of the U.S. would be the vice chairman instead of the chairman. But David was, I think, at the time, the youngest professor in the history of Harvard, so certainly a very well-regarded figure in monetary economist. So, but that's how close you have to be to the situation to have any idea what's going on there. So Claudio Barrio is their chief monetary economist, and he gave this speech in Zurich, Switzerland, just last week. He said exactly what you said, John, that the international monetary system is rudderless, has no anchor. There's no gold standard. There's no dollar standard. I would say from 1980 to 2010, the reason things were not more chaotic is because we had a dollar standard. That may not be a strong anchor, but it's something. The U.S. was committed to a strong dollar before President Obama and Mike Froman launched into the currency wars in 2010. There's no anchor at all. By the way, I can relate two other conversations. I may have mentioned this on the call, on the podcast before. I'll be brief, but I spoke to Ben Bernanke, former chairman of the Federal Reserve in Korea not long ago, and shortly thereafter I spoke to John Lipsky. John, interesting figure. He was the only American ever to head the IMF, which is odd because the deal at Bretton Woods was an American would head the World Bank, and a European or non-American basically would head the IMF. So how on earth do you get an American head of the IMF? It's never happened. Well, the answer is it happened once when Dominique Strauss-Kahn got arrested and had to resign under dubious circumstances, to say the least, and they weren't ready with a successor. So John stepped in he was the first deputy managing director, so he became, in effect, acting head of the IMF. But he was at least nominally the head. I spoke to both of them, so head of the Fed, head of the IMF, 9,000 miles apart, two separate conversations, and they both used the same word to describe the international monetary system. They both said it's incoherent, and I knew they didn't rehearse that for my benefit. I knew that was in the air, and incoherent just means no anchor, no rules of the game, and that's exactly what Claudio Barrio said last week. So basically the whole world wakes up, and every day is jump ball. Every day is jump ball. We don't know what currencies are worth. We don't know who's up. We don't know who's down. Again, part of the reason there's a flight to gold, because at least with gold you've got a little bit more confidence in it. They're not printing any more of it. Mining output's only about 1.6% a year, so the physical supply doesn't go up that much under the best of circumstances. But Barrio said an interesting thing. He said, well, the international monetary system is, he said, incoherent. There's no anchor. You're exactly right. He referred to the SDR, the special drawing right. That's the world money issued by the IMF. And he said, because other speakers, this was a monetary conference, all-day event, and there were other speakers, including William Dudley, the president of the Federal Reserve Bank of New York. And Barrio made reference to the fact that some of the speakers were referring to SDRs. And he said, why is the SDR any more of an anchor than anything else? What's the anchor for the SDR? which I think is a very good question. He didn't answer the question. He just raised it rhetorically. But, of course, there is no anchor, and left hanging in the air is gold. Gold has been an anchor. Interestingly, when the SDR was created, when the special drawing right was created, a funny name, by the way, but just think of it as world money. It's really easy to understand. An SDR is world money printed by the IMF. IMF is a printing press. They can print these SDRs and hand them out. So don't let the funny name or the initials SDR throw you off. It's just world money printed by the IMF, comes out of thin air, handed out to the members, gets used just like any other kind of money. It's not that hard to figure out. But interestingly, when the SDR was invented in 1969, it was convertible into gold. The definition of an SDR was a fixed weight in gold. They actually called it paper gold. It was meant to expand reserves at a time when the U.S. was still on a gold standard. Well, they got rid of that within 2 years. When the U.S. abandoned gold in 1971, the IMF abandoned the gold linked to SDRs very shortly thereafter. I forget the exact date, but it was sometime around 1972 or so. So now the SDR is just another fiat currency. But, and I've hypothesized this in my books, in particular Chapter 11 of The Death of Money, you could have a gold-linked SDR. You could have an SDR that would have some reference to gold. That would address Barrio's argument. And obviously, once you do that, if you want to avoid deflation, you're talking about much, much higher prices for gold. I've said publicly I expect gold to go to $10,000 an ounce, which I do. When I say that, it's not a number I pull out of the air just to attract attention or be provocative. It's actually the implied non-deflationary price. It's actually the lowest price that gold would have to be in a gold standard to avoid deflation. Any lower price for gold, any lower dollar price for gold would be deflationary. It would be a blunder. It would throw the world into a recession, if not a full-blown global depression that you couldn't get out of. So I'm not saying that you have to have a gold standard. I am saying that if you have a gold standard, you've got to get the price at least at $10,000 an ounce. So again, going through all these hedge fund mavens, professors like Ken Rogoff, economists like Claudio Barrio, and others, this is very much front and center in the elite conversation today.
Well, thanks, Jim. And now over to you, Alex. What questions do you have today from our listeners?
Thanks a lot, John. We've got a ton of questions that have come in, so we thank everybody for sending their questions in. There's a lot of really good questions here, so it's kind of hard to choose from them with the time that we have allotted, but we're going to do our best to get some of these answered. Just a brief comment is that in my time in the physical gold industry, which has been almost a decade now, as you well know, Jim, the whole idea of using gold to back the currency or to talk about gold in any legitimate fashion as money has been pretty much laughed at and ridiculed by leading economists and central bankers, etc. And not only is this happening now, this sort of sea change that's currently occurring and is still underway, that's being discussed at some of the highest circles now, but it's also kind of starting to filter down into other people's consciousness. And I'm talking about people who don't make monetary policy, but just the typical person who's concerned about their savings and concerned about protecting their wealth. And a couple of examples, as you know, Jim, you met with the governor of Texas and you were talking to them about this gold vault that they're going to be building soon. There's a new bill that's been passed by Tennessee, or not passed, but introduced in Tennessee to build a similar gold vault in Tennessee. It's also been mentioned in the recent presidential race by several of the candidates. So it's kind of leading to where people are starting to, I think, maybe wake up a little bit, people who didn't necessarily think about these kind of things in the past, which kind of leads me to our first question here. This one's coming from Michael W. So I'm just going to read some of his introduction. He says, Jim, I enjoy your blogs, interviews, and books. He likes the simplicity of your explanations. After reading Currency Wars, my first reaction was what at the time seemed obvious, and that is just simply eliminate competitive devaluation by requiring internationally the pricing of all goods and services everywhere, quoted in one currency, ounces or grams of gold. In other words, eliminate country names such as marks, yens, pounds, dollars, etc., and make it some kind of internationally mandatory system. So what he wants to know is, what is your view of that? And is that something that's realistic? I'm paraphrasing a little bit, but that's essentially what he's asking here.
Well, I think it is possible to denominate every good or service in the world in units of gold. I don't think that would be that difficult, but then it begs the question, well, what are we going to do? Are we going to walk around with bags of gold in our pockets? How are you going to get paid on payday? How are you going to pay your rent or your mortgage or buy a new car, etc.? The reason for paper money, which are really just banknotes or just promises, was partly convenience, and the reason for digital money is partly convenience. We always say that the Federal Reserve is printing money, conjures up a printing press with ink and paper, and that is the way they used to do it. And there is still paper money in circulation, but not much in relation to the money. Your money is digital. If you think about it, you may have a few bucks in your wallet. I stopped at the ATM on my way over to do this podcast, so I got a couple 20s in my wallet. But basically, you get paid digitally. You pay your bills online. Use your debit card. Use your credit card. You check your bank account online, etc. It's all digital, which that leads to other issues such as your digital wealth being wiped out by hackers, but let's leave that aside. That even if you denominate everything in gold, you'd still have some kind of token, whether it's a digital token or paper money, to pay for things. And at that point, it begs the question, well, okay, what's the relationship between my token and the gold? Do I still have a dollar bill? Does it take me 5,000 of those dollar bills to get 1 ounce of gold? Or you could have a banking system, I guess, where you combine a digital system and a gold numeraire, where I look at my bank account, instead of so many dollars, I've got so many ounces of gold, and if I want to go buy a new car, it costs me X ounces of gold, and I just use my debit card. So that is possible. The problem is, the thing that it confronts is, think of central bankers as having a monopoly on central bank money, which they do. If you had a monopoly on anything and you had all the power, what's more powerful than printing money, right? If you control money, you control price levels, you control wealth, you control whether people have jobs or not, you control politics, you control pretty much everything if you control money. Right now, that's in the hands of a bunch of PhDs from Harvard and Yale and MIT and Chicago and Stanford and Oxford and a few other schools around the world, but not many. It's a pretty short list of schools. I mean, actually, as an interesting exercise, go look at the resumes of the heads of the top 10 central banks in the world. Not hard to find. You can find that online. You'll find that they all went to like 3 or 4 schools, mostly MIT. So it's a club. They're in control. Why would they give up that control? Why? Who voluntarily gives up power? So you're going to the idea of saying, okay, now we're going to price things in gold by weight. That's the universal benchmark. That's the universal numeraire. We can use 21st century digital technology to hold our accounts. There's some gold somewhere behind the system, maybe in a vault or something, but my share of it is represented by gold units in my account, and that's how I pay for things. That's a feasible system, but you're never going to get buy-in from any central bank in the world. When you own gold, you're fighting every central bank in the world. So what is it that could cause the system to move in that direction? 2 things, a political earthquake, and maybe we're seeing one right now with the rise of Bernie Sanders, the rise of Donald Trump, the Brexit vote in the UK, backed by some flamboyant and charismatic politicians like Nigel Farage and Boris Johnson. Maybe we're seeing something like that, so let's kind of watch that space. But the other thing, I think the more likely path would be collapse, that there's a panic, bigger, much worse than 2008, massive destruction of wealth, a completely dysfunctional system, an emergency response, borderline neo-fascism, money riots, state power designed to suppress the money riots. And in that world, maybe when the leaders of the international monetary system realize that they've completely lost credibility, they're pushed into something that restores confidence, and that could very well be gold.
Very good. I'm glad that you mentioned the part about digital money, because we've actually had a lot of questions coming in regarding some form of digital currency backed by gold, and I think you're answering the previous question also handled some of those as well. So moving on, the next one is about the Fed and potential rate hikes for June. We've got a number of different questions coming in about that. One in particular, is there any reason, with the exception of a purely political move, to support Clinton for a rate hike in June? Most reliable sources point to a failed recovery. That's coming from Jim L.
I don't think the Fed is unaware of politics, but if you want to help Hillary Clinton, you would not hike rates in June. And that is what I expect. I know there was a lot of buzz today because the minutes of the April meeting were released, the April FOMC meeting, and those minutes included comments by some of the regional reserve bank presidents to the effect that if data were stronger and growth were higher and inflation were a little higher, the Fed should raise rates in June, and we saw an immediate reaction. Gold went down a little bit. Stocks went down a little bit. I don't get too exercised one way or the other about developments like that. I certainly pay attention to them. I mean, I'm not saying ignore it. I do look at it, and I'm enough of a geek. I read those minutes, and I read the speeches, and a lot else beside. But I don't think that you necessarily should react day to day. The Fed doesn't. The Fed actually, we talked about this conference in Switzerland where Claudio Barrio gave the speech about the anchor. Bill Dudley gave a speech the same day, and he made some comments. Sorry, he did give a speech then, but I was referring to an interview he gave to the New York Times. Sorry, but have a look at the interview in the New York Times, easy to find. And he said he was talking about the difference between a meeting with a press conference and a meeting without a press conference, and whether the non-press conference meetings were live in terms of raising rates and changing policy, et cetera. And he was trying to make the point that they were, that markets should not completely discount the possibility that they could raise rates at a meeting where there was no press conference. But in the same breath, he said, on the other hand, what difference does a month make? So he was being completely relaxed about, if you're going to do something, if you did it in June, July, or September, does it really matter? And he said, no, not that much. It matters in the aggregate, but one meeting versus another doesn't matter that much. So you had all this talk, and there were a couple data points recently that look a little hotter. Atlanta GDP Fed now, the GDP Now tracker is showing some strength. One of the inflation readings was a little bit hotter. You're going to have to see more than that to get the Fed to move. But just kind of going to the political aspect of the question, about a month ago, the president summoned Janet Yellen to the White House, and I use the word summoned by design. It's not unusual for a Fed chairman and a president to chat. I mean, they'll have breakfast or lunch periodically. Alan Greenspan and George W. Bush used to meet, once or twice a month for breakfast. So the fact that they talk is not unusual. What is unusual is that this was very short notice, very public. They invited in the press. They had Vice President Biden in the room, and a lot of people said, well, gee, what did they talk about? I got a lot of calls in the press. What did they talk about? I said, it doesn't matter what they talked about. It was all in the body language. It was the sight of the president sitting next to Janet Yellen in the Oval Office saying, in effect, the body language said, don't you dare raise interest rates. Because they did raise interest rates in December. That was the famous liftoff. And what happened? The U.S. stock market almost collapsed. It fell over 11% in 5 weeks from January 1st to February 11th. That was a meltdown. That scared them to death. So that's why they backed off all the rate hike, the four hikes per year, every other meeting, all that stuff that they laid out in December was completely blown up by really by the end of February, but they put the final nails in the coffin with Janet Yellen's speech before the New York Economic Club on March 29th, 2016. So that completely went by the boards. But the reason was that the U.S. economy was fundamentally weak. Raising rates would be enough to tip it into a recession. That could destroy the Democrats' chances of winning the White House because, generally speaking, it doesn't matter which party's in and which party's out. If you have a recession in an election year, the out party wins. Simple as that. So with the Democrats being the in party and the Republicans being the out party, you have a recession in 2016. That's really going to help the Republicans and give Donald Trump a significant boost on the way to the White House. So the last thing the White House wants is for the Fed to raise rates. So that's what that was about. That was just a little bit of an intimidation, body language kind of exercise. So I think the hurdle is quite high for a rate hike this year. By the way, last December, I was one of the ones who I made the mistake of believing the Fed. I actually believe what the Fed said, and I was expecting a rate hike in June, but it was very clear to me by February that that was not happening. And now I don't see enough signs the other way to suggest that they will raise rates in June. So I'm still expecting no rate hike in June. I mean, you have to see some off-the-wall or off-the-charts data between now and then. It's possible, but I think it's very unlikely. And then forget September. Oh, by the way, sorry, one more reason they won't raise in June. The meeting is 6 days before the Brexit vote. The market, this is the referendum in the UK to leave the European Union. Of course, all the elites are lined up on the side of staying, kind of everyday people, and some politicians, Boris Johnson, Nigel Farage, two I mentioned, but a lot of others, including some former ministers in the UK, former cabinet ministers, are in favor of leaving the EU. The polls right now are very close. I don't know which way it's going to go, but I do know it's extremely close. I think we're sadly maybe one terrorist attack away from a leave vote. It wouldn't take much in a 50-50 contest, which is where it is right now. It wouldn't take much to tip that into leaving. The markets have not priced that in. The markets expect on balance that they'll stay. If you leave, what does that mean? I think if the UK leaves the EU, you'll see Scotland leave the UK. Scotland at that point will need some kind of money. They'll probably join the euro. The euro could actually get stronger. The UK has a conditional one-step removed call option on the ECB or the Eurozone's goal, which is 10,000 tons of gold. The UK could join the euro, and once you're in the euro, you in theory share in that 10,000 ton gold reserve. But if you leave the EU, then you have no chance. You give up your option to join the euro. You're on your own. The UK doesn't have that much gold, so they'd be completely cut off. City bankers would move to, there's already a bidding contest. Dublin and Monaco and Paris and Frankfurt are all getting their real estate agents ginned up and getting ready to move all these bankers to some other financial capital. Maybe it goes to Glasgow or Edinburgh in Scotland. We'll have to see. But the point being, that's an earthquake the market hasn't priced, and we don't know how it's going to come out. So do you really think the Fed's going to raise interest rates, which is a mini shock, 6 days ahead of what could be a mega shock that the markets haven't priced? Now you're back to the January scenario, or worse yet, you're back to the August 2015 scenario when China did that Pearl Harbor with that shock overnight 3% devaluation of the Chinese yuan. I asked investors, where were you on August 31st? Maybe you were taking your kids back to school or on a nice vacation, but you probably thought you were, if you weren't at the Grand Canyon, you probably thought you were staring into the Grand Canyon as far as the stock market is concerned, because U.S. stocks were crashing at the end of August. But that was all because of that Chinese devaluation. So that's how fragile the global economy is. You can't throw too many shocks at it without the whole thing breaking down, and they know that. So because they've had it twice, once in last August I just referred to, and again in January. So they don't want to do that again. And I can't rule it out completely, but I give it a very, very low probability. And also the politics come in. Janet Yellen is a Democrat, a liberal Democrat. That's not casting aspersions, it's just a fact. And she wouldn't mind probably being reappointed by a Democratic president. And what President Obama was saying to her was, well, you need to do your part here for the party and not raise rates. So, and then I don't expect to raise it in September, because now you're talking literally 5 weeks or 6 weeks before the election. So it would be way too close, and the Fed's in the political crosshairs to begin with. They don't certainly want any political trouble. What if they cut rates, for example, and then the Republican somehow wins? They'll probably go burn down the Fed. So they might not raise rates at all until December at the earliest. I don't read too much into those minutes that came out today.
Okay, very good. Now, we still have a number of very good questions in the queue, and we've got a limited amount of time left, so we're going to try and get through some of these quickly if we can. Briefly, before we go to the next question, we've had some people asking about if people will be able to access these webinars after the fact, and the answer is yes. We record these and we will post them at physicalgoldfund.com/podcasts. We will send out a notification to everybody who's here on the webinar. We will let you know when that's available. And in addition to that, it's also available on iTunes. So the next question is kind of taking the other side of the analysis, Jim, to gold. This is coming from Peter W. from Germany. And he's asking, can you outline the most likely scenario in which the gold price would go down substantially in most currencies, and what probability would you assign to such a scenario?
Well, the likely scenario is obviously a deflationary scenario, but when you talk about going down, you have to distinguish between nominal dollar prices and real dollar prices. So let's just say that gold went, I mean, right now it's about $12.70 an ounce as of this afternoon. I mean, it fluctuates daily, obviously. Let's say that gold went down to $800 an ounce. So that would be a 30% decline from where we are today. A little bit more. That'd be like a 35% or slightly higher decline from where we are today, which would be a major drawdown. Well, what does that mean? The point is nothing happens in isolation. If the nominal price of gold were to go from, say, $12.70 to $800, that means the price of everything else is going down more. That's a hyper-deflationary scenario. And, I once said to somebody, to one of my clients, I might like $500 gold better than $5,000 gold. That sort of puzzles people, but I say, look, the world of $500 gold is the world of 500 on the S&P and 2,000 on the Dow, and a complete destruction of financial wealth and 10% unemployment and a collapse of the economy worse than 2008. In other words, gold doesn't just go to $800 or $600 on its own. It goes there because you're in a hyper-deflationary, depressionary, panicked environment. In that world, I might want my gold even more than I do today. And so I think investors, it's a little simplistic to talk about the dollar price going up or the dollar price going down. First of all, I don't even think of it that way. I think of the dollar price of gold as just a cross rate. It's like, you can say the euro is worth $1.09, or there's 105 yen to the dollar, whatever it is. Those are all cross exchange rates. Well, I just think of the dollar price of gold as another cross rate between two kinds of money, dollars and gold. And when someone says gold went up or down, I think, well, no, the dollar went up or down. A higher dollar price for gold means the dollar is going down, and a lower dollar price for gold means the dollar is going up. In other words, the value of the dollar is going up, which is the definition of deflation. You get more stuff for your dollar. Well, in a hyper-deflationary world, there's probably so much disruption and so much wealth has been wiped out, you might want your gold even more. So first of all, distinguish between nominal and real. That's important. Understand that nothing happens in isolation. See, gold is not a stock. It's money. So yeah, an individual stock can go down. You can have a situation where the stock market's going up and an individual stock is going down because it's, Lending Club or Tesla or something happened to that company. Stocks are idiosyncratic, but gold isn't. Gold's a form of money. And if one form of money is going down relative to another form of money, then that's just a form of deflation. So understand that nothing happens in isolation. Distinguish between nominal and real. Don't get too euphoric if gold goes up a lot, because it means that your dollar is worthless. And don't get too depressed if gold goes down a lot, because that means that everything else is probably going down too. And this is a debate. You hear this from, and these are not, well, I think of the right word, but you hear from people like Harry Dent and Michael Armstrong. They're out there with their blogs and their speeches and their newsletters talking about $800 gold. And I completely disagree, by the way. But if it were to happen, there would be so many other bad things happening at the same time that you'd be glad you had the gold.
Okay, very good. And then one last question here is that this is coming from Anthony K. And his question is, now that China has acquired some 2,000 tons of gold, are they now on par with the United States?
Well, it's a great question. Officially, China is approaching 2,000 tons of gold. I don't know whether the latest monthly update came out today or recently. It's possible that they hit that level. The last time I looked, it was around 1,800 tons. But, that's close enough for government work, as they say. But they're certainly closing in on 2,000 tons officially. But that's a lie. They have a lot more gold, and you can demonstrate why they have a lot more gold. I talk about this in my book, The New Case for Gold, and also in The Death of Money. They have another, because those gold figures come from the central bank, but they have another sovereign wealth fund called the State Administration on Foreign Exchange, SAFE, S-A-F-E, and that's where they keep most of the gold. So what they do is they acquire the gold through SAFE, and then they don't reveal it, and then periodically they move the gold over from SAFE to the People's Bank of China. So it's just like taking gold out of one pocket and sticking it in the other pocket, and then the People's Bank of China publishes the new number, and everybody says, oh, China got some more gold. Well, no, they didn't. They had the gold all along. They were just keeping it in a place you couldn't see, and chose for their own reasons, really political and market manipulation reasons, to be transparent about how much more gold they added to the People's Bank of China. So that said, the Chinese actual number is closer to 4,000 tons. No one has the exact number because we have to use estimates from various sources, but they're probably around 4,000 tons, perhaps a little bit more. In terms of closing in on the United States, there are two ways to think about that. One is absolute tonnage, and if that's your measure, they're only halfway there. The United States has about 8,000 tons. My estimate is that China has about 4,000 tons. So they have about half the amount of gold that the United States has. But the other way to think about it, and I think this is useful, is a gold to GDP ratio. So take your gold at the market, divide it by your GDP, and the reason for that is if GDP is the size of your economy and gold is real money, which I think it is, then you're asking yourself, well, how much gold do we have to back up the economy? How much gold do we have to support a certain quantity of goods and services, a certain quantity of output? What's the real money supply relative to the size of the economy? By that measure, China has caught up with the United States. They have about half as much gold as we do, but their economy is about half the size. So on a gold to GDP ratio, those numbers are around 2%. They fluctuate, by the way, because economies grow and the amount of gold changes, at least in the case of China. So the numbers bounce around a little bit, but they've caught up to the U.S. At about 2% of GDP. But remember, the Chinese economy is growing a lot faster than the U.S. economy, so it's a moving target. So even if you caught up, you have to keep buying, because if you stand still, you're going to fall behind because your economy is growing faster, which means you have to buy more and more gold just to maintain the ratio. And certainly if you want to catch up in tonnage, get to 8,000 tons, which they probably do because they expect their economy will overtake the U.S. in the not-too-distant future, then you've got to keep going. They've got to buy another 4,000 tons, maybe more. And this is part of this scarcity dynamic we talked about earlier, which is there's only so much, total mining output in the world, total mining, all the mines put together, about 2,000 tons a year, give or take. Well, with the Chinese out to buy, 2,000 tons a year, and that's 100% of the mining output in the world. Well, there are a lot of other buyers out there, not to mention jewelry and Indian brides and wedding rings and and watches and a lot of other things. So I think that tightness will continue. But the short answer is China has caught up in gold to GDP. They have not caught up in absolute tons, but for them it's a moving target because their economy is growing faster, so they have to keep buying. Okay,
very good. And from your experience and our experience in talking to and having conversations with the refineries over in Switzerland, we already know the huge amounts of gold that have been going over to China in recent years. And a yes or no answer, do you think the pace at which they've been buying is going to keep up?
Yes.
Okay, very good. All right, Jim, thanks so much for your time. We always appreciate it. Thank you, everyone who's participated in the webinar. We thank you for your questions. Apologize we couldn't get to the rest of them. There's still a whole bunch of really good ones. We encourage you to send questions in to info@physicalgoldfund.com. We'll put them in the queue, and hopefully maybe we can get them answered in the next webinar that we do. And with that, I will turn it back over to John.
Oh, thank you, Alex, and thanks to you, Jim Rickards. Have to acknowledge the shortest ever Jim Rickards answer there, but we love your long answers. Always a pleasure and an education having you with us. Most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon. You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.
So I do think it's a very, very significant development and a change in sentiment. We're also seeing it in gold mining stocks. I'm not a stock picker, but there are fabulous opportunities there, and for those who do the analysis and can find the right companies. So yeah, I think sentiment's changed, fundamentals have changed. We've said on this podcast, going back over a year, we said the technical setup was there. We were seeing physical shortages based on our conversations with people on the physical side of the business. By physical, I mean refiners, vault operators, secure logistics operators, dealers, entities like the Physical Gold Fund, where they handle the real stuff. When you deal with Physical Gold Fund, you're talking about physical gold kept in a vault. This is not paper gold. So from that end of the business, we've seen the tightness in supply for a long time. We've also seen the voracious demand coming from China and Russia notably, but also Iran, Kazakhstan, Mexico. There are a lot of countries around the world who are acquiring gold. There are no central banks that are selling any significant amount of gold. People made a big to-do about the Canadians dumping their gold, which is too bad for Canada, but they only had 3 tons. It wasn't as if they were dumping 30 tons or 300 tons. They only had about 3 tons left, and they did dump it. So no significant selling, a lot of significant buying, physical shortages cropping up, the paper gold to physical gold ratio near all-time highs, COMEX warehouse being stripped practically bare, open interest relative to physical gold close to all-time highs. So the setup was there for a big price increase. So that's not surprising. But combine that, let's call it the technical setup, with the fundamental setup, which is lost confidence in central bank money, and then smart people coming out with a kind word to say about gold. It's been a good run, but this is just beginning. Gold could go up or down on any given day. It's down a couple bucks today, but I'm not a day trader. That's not how I think about it. I think about it as a store of wealth, as a way to protect yourself against the storm and coming collapse in confidence in central bank money. So, but it's not too late to get in. This thing has a very long way to run.
Well, thankfully, in net outflows in the last quarter of 2015. But not only that, there's a change in the conversation. We're seeing big names in the financial world coming out with positive statements about gold. People like former IMF chief economist Kenneth Rogoff and billionaire fund managers like Paul Singer, Stanley Druckenmiller, Jeffrey Gundlach, and institutions like JP Morgan's private bank and the massive investment firm PIMCO. And we'll talk about some of their particular pronouncements later in this interview. But just to begin with, Jim, stepping back to look at the big picture, what's driving this turn in the market? I wondered, has everyone started reading your latest book, The New Case for Gold?
Well, John, thank you for the kind words about the book. I think as you know, as we've discussed, books don't come out of thin air. Unlike money, money does come out of thin air, at least central bank money does. But books don't. They have a very long lead time. So we've all been working on this book for over a year. There was no way to know a year ago that we would have a publication date in the strongest performing quarter for gold in over 20 years. So that was, cannot take credit for that. It was fortuitous or serendipitous, but certainly the timing's been good, and the book has received a very good reception. But you're right, there's definitely a change in the conversation, a change in the environment, and it's not just the price. Yeah, the price action has been good. Gold's up over 20% so far this year. Best performing asset class. If you look across stocks, bonds, other commodities, various currencies, etc., gold beats them all this year. That's, by the way, not only true this year, it's true for this millennium, or this century, if you will. If you go back to January 1st, 2000, gold has outperformed all the other asset categories I mentioned. Investors are only too aware the gold drawdown from August 2011 to November 2015. Not a lot of fun, but if you take recent action or longer horizon action, gold has done what it always does, which is it preserves wealth and holds it very well compared to other asset classes. But that it's not just the price. There's definitely money out there, and the answer, of course, is gold. So I just think that gold is winning the horse race, if you will, among various competing forms of money, and that's getting some attention and getting some commentary. Now, we'll spend a little more time in the interview on some of the specifics of some of the names you mentioned. By the way, John, it was a pretty good list. You had Stan Druckenmiller, one of the most successful long-term investors of all time, one of the great hedge fund managers, protege of George Soros, went out on his own, with Duquesne Capital Management, now runs it as a family office, but one of the best long-term track records out there. Same thing with Paul Singer, runs Elliott Capital Management, and a few other names you mentioned, but you left out the biggest one of all, which is understandable because it's only in the last 24 hours, but George Soros, came out the other day, and he didn't actually make a public statement, but what happens for large institutions, they have to file a form called a 13F. That's one of these SEC forms. They come out quarterly, a certain number of days after the end of the calendar quarter, and depending on your size, if you're above a certain size, you have to actually disclose what you're holding. So the Soros 13F came out, and analysts had a look, and what they saw was that he had decreased his stock market bets 37% and increased his gold bets very significantly. In particular, bought a very large stake in Barrick Gold, which is either the first or second largest. I think it might be the first largest gold mining operation in the world, Canadian company. Interestingly, the chairman of Barrick Gold is John Thornton, former co-CEO of Goldman Sachs, and very well connected in China, very close to the Chinese. Actually spends a lot of time in Beijing, has an there. So Thornton's an interesting figure. Again, top guy at Goldman Sachs, one of the most connected Westerners in China, and the chairman of Barrick Gold, and that's the company that George Soros is buying into. So these guys are, when you talk about Druckenmiller, Singer, and Soros, you're talking about the best. They're not flash in the pan guys. They've been doing this for 20, 30 years. In Soros' case, more like 40 years.
Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. Great to be with you.
And we also have with us Alex Stanley, the managing director of Physical Gold Fund. Hello, Alex.
Hi, John. Great to be here. We have some very exciting topics to discuss today, so looking forward to getting into it.
We certainly do. Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question, and as time allows, we'll do our best to respond to you. Now, just a word about Q&A, because we want to emphasize today that we really value the questions that you send us, and we decided to increase the portion of time each month to your questions. But today we will begin with an interview covering some very significant market developments that we've been seeing since our last webinar. So, talking of which, Jim, it seems like the West is finally waking up to gold. Let me quickly list off just some of the factors. We've seen a roughly 20% rise in the dollar price of gold since the beginning of the year. We've seen a dramatic, less reported, but a dramatic increase in gold buying by institutional investors. By reports I've seen, over 13 billion in net inflows this year compared with 2.5 billion.
Change in, I think you put it, the conversation. And this goes back to something I wrote a little while ago. I said gold is a chameleon. And what I meant by that, of course, I think of gold as money. But I said, there are times when gold trades like a commodity. It's in the commodity indices, it's part of the commodity complex. It looks like a commodity because you dig it up out of the ground the same way you do with copper or iron ore, etc. I don't really think of gold as a commodity, but there's certainly times when it trades that way. Gold is also sometimes considered an investment. It competes in institutional portfolios for an allocation side by side with stocks and bonds and some of the asset categories we mentioned. But sometimes gold is money. And I think what happened, I traced this really to late 2014, but it really gathered steam recently, is that investors in general are losing confidence in central bank money. If you think of it as a competition, there are a lot of forms of money. I would say the dollar is money, the euro is money, Bitcoin is money, gold is certainly money, silver can be money at times in the past, feathers and clamshells have been money. So money can take many different forms based on shared values and confidence that other people will take it as a unit of exchange. And right now what's happening is that investors are looking at central banks. They're saying, 7 years on, almost 8 years from the financial collapse, growth is still well below potential. Debt is still rising faster than growth. Debt to GDP ratios are increasing. True, we have not seen that sort of spectacular collapse in the international monetary system, which I do expect. I'm certainly not taking that off the table. I've been writing about it and thinking about it for a long time. It hasn't happened yet, but the signs are that the system is under more and more stress. And the central bank policies are not only failing to get economies back to trend growth, but they're increasingly seen as futile. In other words, if you just do more, it's like the old joke about, more cowbell from that old Saturday Night Live skit. Doing more isn't working. And so if you're an investor and you say, well, we don't have much confidence in the Fed and their dollars, or the European Central Bank and their euros, or the Bank of Japan and their yen, is there another form of